allow Europe in particular to take a more sort of extreme, move as it relates to sort of an oil embargo in Europe. The release of oil from the Strategic Petroleum Reserve that was announced last week was really extraordinary, the biggest release announced ever in the history of the SPR that was formed in the 1970s. So I think the White House is really not pulling any punches here. They're trying to do everything. They're sort of waging this multi-dimensional, war, so to speak. But again, there are limitations. They do have sort of limitations. And again, from a sanctions perspective, I think we're pretty close to that frontier.
You mentioned China in particular. This is not the only country that is perhaps aligning itself with Russia in terms of keeping the strategic interests afloat. I'm curious about the U.S. policy when it comes to the Middle East, when it comes to India, some of these other countries that haven't yet cut ties in the same way that the United States and Europe has. What is the take when it comes to those countries?
Yeah, I think what President Biden and the White House and their national security staff and their State Department are doing is a lot of diplomacy behind the scenes as it relates to India. You have the National Security Advisor Deputy Dalip Singh over in India, I think probably making those arguments behind the scenes that there's sort of limitations in terms of how much India can and should support Russia. Saudi Arabia and the UAE, obviously very big OPEC members, so important from that perspective. I think you could probably see, maybe some overtures from the White House as it relates to Saudi Arabia in particular over the coming weeks, from lots of different perspectives, diplomacy, from sort of the Russia perspective, but again, from just given their sort of outsized role in terms of their OPEC contributions as well.
Libby, can I ask you a slightly left field question? Elon Musk has just taken a passive stake in Twitter. I'm wondering how it will go down in DC if that passive stake becomes an active stake. What do you think?
That is sort of a left field question. Thanks, Guy, for that. Look, I mean, I think Elon Musk is a pretty controversial figure in Washington. There is sort of this idea that sort of big is bad in DC, and I think Elon Musk and Tesla and sort of his bully pulpit is sort of in line with that thinking. Whether he takes an outsized view role in or ownership in Twitter sort of remains to be seen. But yeah, I mean, there is a lot of attention on people like Elon Musk, and I'm not sure how many friends he has in Washington on either side of the aisle, honestly.
No, I'm just wondering, given the fact that social media has become such an important part of the political discourse, having a guy like Elon Musk controlling one of the kind of the bigger elements of that, I'm just wondering how that would go down. I'm just wondering, I guess what I'm really getting to is he running a risk here? He's basically, like Jeff Bezos with the Times and other businesses, he's stepping in to a world that maybe he's not as familiar with. And I'm wondering, and you look at what's happened with Jeff Bezos and you look at some of the pushback that he's had and how that's impacted Amazon, I'm wondering if there's a risk here for Elon Musk in potentially taking this route.
I mean, potentially, but I think even sort of before this, and regardless of Elon Musk's, involvement in Twitter or in sort of big tech is very much has a pretty significant target on their back. Again, sort of this idea that big is bad in Washington very much stands across both sides of the aisle. It's one of the very few things that actually Republicans and Democrats sort of agree on, though for different reasons. So for sure, does this maybe amplify that target? Maybe, but again, I think sort of pre-existing Elon Musk's involvement in Twitter, there was already a lot of focus on Twitter, but then also, of course, on Facebook and other social media platforms.
Libby, thanks for playing. Really appreciate that. Really appreciate you answering the questions. I think everybody's trying to figure it out, what the risk of him doing this ultimately is. Libby Cantrill, PIMCO, Head of US Public Policy, thank you very much indeed. Please come back again. Coming up, JP Morgan CEO Jamie Dimon speaking out on everything from the war in Ukraine to why he feels sorry for the Fed. That conversation next. This is Bloomberg.
America's greatest minds.
Well, we're a little over an hour into the U.S. trading session. A little bit of green on the screen. Bloomberg's Abigail Doolittle is tracking the moves. Abby, what do you see?
Well, Creedy, we do have the bulls in charge by a slight degree here in the U.S. That S&P 500 up about 0.3%. An up day for a second day in a row. We have stocks in Europe up just a little bit more, up 0.75%. And despite the idea that there's a strong chance that Europe may end up sanctioning Russia more for the war crimes that we've all been seeing, you have European stocks higher. You also have commodities higher on the possibility of those sanctions. So oil back above $100 per barrel, WTI crude at 103, and wheat futures up nearly 2%. Now, last week, one of the big events, of course, was the inversion of the 210 yield curve. That is still the case. And then when we go into the Bloomberg terminal, we'll take a look. We'll see back in time in the 1980s it had been inverted for long stretches of time, but for the most part, not so much. Here around 1990, then around the tech bubble, around the financial crisis, very, very briefly in 2019 ahead of the 2020 brief crash. Right now, though, it is still lower, and there's some reason to think that this yield curve inversion may be more similar to 2007, 6 and 7, maybe even the tech bubble. We'll find out, of course. As for some big movers on the day, the one that's taking everybody's breath away to some degree is Twitter, and right now at near session highs, up 26%, of course, on the news that Elon Musk has taken a passive stake of 9.2%, and that perhaps there's going to be some reshaping to come. Tesla up 3.7% near session highs. This, of course, is Tesla pre-announced deliveries as they do every quarter, record deliveries of vehicles, more than 310,000, suggesting that the company is working around supply chain constraints just fine. And then finally, Starbucks, Guy, as you know, down 5.7%. Founder Howard Schultz has now the CEO again, and on his first day, he has suspended the stock buyback. Investors not liking it for a reason, Guy.
Absolutely. It's going to be interesting to see whether this is the green light for others to follow. Abigail, thank you very much indeed. JP Morgan's chairman and CEO, Jamie Dimon, out with his annual letters to shareholders, covering everything from his thoughts on the war in Ukraine to what he expects from the Fed. He pities the Fed. Hannah Levitt, who covers JP Morgan for Bloomberg News, joins us now. What's the takeaway from this? If you were to read between the lines about Jamie Dimon's assessment of the world that he sees in front of him, is it a positive one or a negative one? How worried is this man?
Hey, thank you for having me. And yeah, it's that time of year again for Jamie Dimon's annual letter. This one was, a bit shorter than last year's 65 pages. This one was 44. And it definitely wasn't as rosy of an outlook. Last year he was saying, this boom could run until 2023. There could be a Goldilocks moment. And this year, he was really digging into the various crises facing the world right now. And the war in Ukraine is definitely high on that list.
Something else he mentioned that I think was high on his list was the Federal Reserve. He said that this tightening cycle is unlike any other that we've seen and that there are a lot of risks when it comes to the Fed simply navigating it. Can you walk us through his perspective on that?
Yeah, so what he said was that in hindsight, all of the fiscal and monetary stimulus in 2020 and 2021 was probably too much for too long. So bank executives don't typically criticize the Fed, and I don't think that was a criticism per se, and he said fiscal and monetary, but it was definitely an interesting perspective. And he also, said that if the Fed gets this right, the economy could be in a really good shape, but that there are a lot of risks and that there's going to be a lot of volatility regardless.
Hannah, what does JP Morgan look like with Jamie Dimon as chair but not CEO? How different an organization do you think it could be?
That's a great question, and I think probably a lot of people, whether it be investors or executives themselves at JP Morgan, are probably wondering the same thing. And so, this is likely not happening for a while. Jamie got his special bonus last year to stay around as CEO for a significant number of years. So this is definitely not something that's happening immediately, but it does pose some interesting questions as to, how the next CEO comes in and does their job while Jamie is still chair.
Well, Bloomberg's Hannah Levitt covering all things JP Morgan. Thank you so much. More coming up next. This is Bloomberg. check on the markets here because you are seeing some green on the screen when it comes to the S&P 500 as a whole, up by about 0.4%. But check this out. The Russell 2000 not playing game here. It is down 0.2%. But once again, these are very marginal moves compared to the over 1% moves we've seen in the last couple of days. And check this out. They're happening at the same time that oil is actually higher as we have some of that sanctions talk about energy. That's not normal. When you see oil higher, stocks have dropped previously. Today, a little bit of movement in the same direction. Is that potentially a coming back to just a risk rally type of idea? And some yields moves coming up about 2 basis points, Guy.
There's a few anomalies over here as well, which I think is interesting. Stocks are bid, they continue to grind higher. You've got travel and leisure doing well today, you've got the luxury stocks doing well. But actually, I think it's the relationship between what is happening with yields and the crude market, which I think is fascinating. So crude is higher, and we are seeing yields coming lower, i.e. bonds are bid. Now, I do kind of wonder whether you can kind of separate these two stories out a little bit. Brent obviously got bashed a few days back by the SPR release. That's a factor that maybe is starting to unwind. The 10-year story, though, over here in Europe, the bond market story over here in Europe is really interesting. So we saw the pictures coming out of Ukraine over the weekend. The expectation is those pictures are ultimately going to lead to tighter sanctions, potentially bringing in the energy complex within the sanctions story. In theory, that should be very bad for the European economy. In fact, Christian Sewing, the CEO of Deutsche Bank, making that point in a speech a little bit earlier on today, talking about the fact that if you bring energy into the sanctions mix, you are going to see a recession. It is going to be inevitable. So in theory, that should mean lower yields. That is certainly what is being priced into the bond market today. So it's going to be interesting to see ultimately the kind of direction of travel that European bonds take, particularly versus what's happening over in the United States. We'll talk more about this. What we got coming up on the European close? Andrew Garthwaite, Credit Suisse's head of global equity strategy. That conversation next. This is Bloomberg. Monday the 4th, European stocks are up, European bonds are up, European energy is up. Countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Minutes to close here in Europe. Let's talk about the price action. European equities up by 0.8%. The Stock 600 retaking 460. We continue to grind higher. The luxury sector's up. Travel and leisure sector is up. German 10-year yields are up. Yields are coming down. Sorry, German 10-year bonds are up. Yields are coming down. As you can see, we're now trading at 52 basis points. We are trying to figure out, I think, what happens next with sanctions following this weekend's alarming pictures coming from Ukraine. A growing expectation that Europe is going to have to figure out a way of sanctioning Russian energy. What impact is that going to have? Well, it's probably going to mean a slower economy, which probably maybe is being priced in here. Brent crude, though, up by 3.3%, 3.4%. We're starting to fade the move that we got as a result of that SPR release, Critty.
Yeah, a similar story when you look at what's going on stateside. What's interesting here, though, there are some cross currents. It tells you investors are maybe having a little bit of trouble digesting what comes next. What do these potential new sanctions mean, at least when it comes to the American consumer? And that's where you can see a little bit of hesitancy, perhaps, in the S&P 500, up only 0.4%. Now, maybe 5 years ago, Guy, up 0.4% on one day would have been good news. Now, it kind of means it's not that volatile. In weeks and months of over 1% moves, to see just this tells you a little bit of muted reaction. Look, it's not actually translating to the Russell 2000, which is really that economically sensitive indicator what we're really looking for, but still not down by a ton, just down 0.2%. But to your point on the Brent crude spot, you're seeing that show up in NY crude as well. New York crude here on the NYMEX up 3.5%, the same margin, over 102. Does it get to 120? Does it get to 150? Those calls still exist in the market, and following, I think what you're seeing perhaps around the world is that risk rally right now. The S&P 500 up, crude up. Why not the 10-year yield up? We're looking at about 241 basis points on the 10-year Guy.
Critty, after the images we all saw coming out of Ukraine over the weekend, the European Union is warning Moscow it will be held responsible for alleged war crimes committed in Ukraine. Broadcasters have shown images of what they say are unarmed civilians who were killed execution style. They are harrowing pictures coming out of the country. Joining us now, Bloomberg's John Verlaine. John, let me just kind of work our way through this story. Bloomberg has been reporting on this throughout the day, the various leaders responding to what we've seen here. As we come together, as we bring these leaders together, as we bring these nations together, what is the response going to be?
Hi, Guy. Well, speaking to EU diplomats in Brussels, there's definitely a change of mood. There are intensive discussions happening on what we do next. What we know is that we have a sanctions tightening of measures, closing loopholes, a few extra measures that have been in the pipeline for some time. And that's going to come up on Wednesday when the EU ambassadors are going to be meeting, obviously, with the European Commission. The question is, do they go further? Do they go for a fifth package? Do they go into energy? And we're still seeing, despite the alleged atrocities, we're still seeing divisions amongst EU member states.
John, we had Libby Cantrell of PIMCO earlier, she's the head of U.S. policy. We talked about what the upper bound is in terms of how much the West can really do. Outside of targeting perhaps energy, what else can Europe and specifically do when it comes to holding Russia accountable?
Well, look, I mean, there are other measures. The problem is what the trigger should be. I mean, other measures include further listings, widening the number of individuals who are targeted by sanctions. But the key discussion right now is, do we go for energy? So we still have, obviously, the usual suspects, Germany, others opposed to measures on gas. Maybe there'll be movement on that, but for the moment, the focus seems to be, if we do go into energy, on coal and oil.
John, these images were extremely alarming, but the expectation certainly is amongst the people I've been talking to that we are going to see more of them. Mariupol obviously remains a focus of attention. As this continues, Can Europe resist the pressure to do more, particularly on the energy front? Where is public opinion on this?
I think definitely the leaders are very aware about the pressure and the intensive nature of the negotiations underway underscores this. The Commission, the executive arm, was briefing ambassadors in small groups over the weekend, well, Friday, Saturday, Sunday. They're going to meet all the ambassadors together on Wednesday, but we need a political signal. We need a political approval to go further. And obviously, the more these atrocities come out, the concern was also about possible chemical weapons attacks. The quandary for Europe is when do we act, or how much do we keep for future events?
Well, Bloomberg's John Folane, thank you so much for your time, for your insights, and of course for your reporting as always. Let's get more on Ukraine. Joining us now is Tyler Kustra, Assistant Professor of Politics and International Relations at the University of Nottingham. His research focuses on economic sanctions and political violence. Professor, thank you so much for joining us as always. Let's talk about the economic sanctions. I'm going to put the same question to you that I just put to our reporter, John. How much more in terms of sanctions can the West really target Russia outside of the energy payments? Are we nearing the end of the toolbox that the West has to hold Russia accountable?
I think the energy payments are obviously the largest tool in the toolbox. They're the sledgehammer. They are what should be used right now. If you see civilians having their hands tied behind their backs and being shot execution style, if you see civilians being raped and murdered like the Russians are doing, I think it's time to get out the sledgehammer here. But we also do have some other options. We could, remove more banks from SWIFT. We could, in theory, target more Russian oligarchs and expand that. And we could expand the options on how far we take those sanctions on oligarchs, not just to the individual oligarchs, but hitting all of their companies really hard as well.
In terms of what we should expect next, Professor, we've seen obviously the images, similar images coming out of Chechnya and Syria. Is this similar? Is this the same playbook that is being applied here? Should we expect this to continue? And if so, do we need to keep? Do we fire all the guns now? Do we shoot all the sanctions bullets now, or do we need, as we were just hearing maybe from John, for some of them to be reserved for later?
Well, I don't see the point of reserving sanctions bullets for later when we're in a position where we have so many dead civilians right now. I mean, if we reserve them for later, then all we're going to do is impose them after more people get killed. I think we should impose them now and send a strong message to the Kremlin that this is completely unacceptable and force the Kremlin to stop this war. I see no reason to leave sanctions until we've unearthed every mass grave that the Russians have dug in Ukraine. That's ridiculous.
Professor, can you talk to us about the efficacy of these sanctions? If you're saying we should use all the sanctions we have in our toolbox right now, and it doesn't really work, and the Kremlin perhaps continues these atrocities, what next? What comes next when you already see some of these relationships being created between Russia and China, Russia and India, Russia and the Middle East? Is there a way where they can actually avoid the impact of sanctions in its full effect?
They're going to try to avoid the impact of sanctions, but remember, so much of the Russian economy is selling natural gas to the EU, right? And that natural gas flows in pipelines from the Siberian natural gas fields west into Europe. Those pipelines don't connect to China. Those pipelines don't connect to India, and they don't have liquefaction capabilities to actually move that gas there via ship. So, the EU is Russia's biggest buyer, and they don't have as many other options as one might think.
But what is the purpose of getting those payments if perhaps the dollar spending is already frozen? If you can't actually spend the money that you would be getting from these natural gas payments, what's the point of continuing the shipments when perhaps there's other things they have their eyes on? For example, freshwater reserves when it comes to Crimea, or other sources of customers when it comes to other parts of the world. Why focus on those payments?
Why focus on the payments? Well, I mean, quite frankly, it is what Vladimir Putin needs. That money goes into his bank accounts and he can try to launder it to get it out to buy other things. So long as it's flowing into Gazprom Bank, so long as it's flowing into Gazprom and Rosneft, that money is accessible to the Kremlin. So we have to sit down and hit the Kremlin hard and say, look, you're not going to get this money. You're not going to be able to have it.
Yep.
That money is not going into escrow right now.
Professor, sorry to go sort of full Clausewitz here, but clearly once we've reached the end of the kind of the mercantile element, and Clausewitz sort of compared the sort of the bill gets paid at the end of these conflicts. Let's talk about what comes once we've exhausted the mercantile. What comes next after this? Are we ultimately heading down this spectrum towards ultimately military confrontation? If the sanctions don't work, if the use of energy sanctions doesn't work, back to what we were talking about in terms of the toolbox. Is military the only thing that's left in the toolbox after that?
I think after we've wound up going through the sanctions, we can also talk about ensuring that Zelensky gets the supply of material he needs, gets the supply of bullets, gets the supply of anti-aircraft weapons, etc. coming in. That's certainly a possibility. But you're right, there isn't a lot after we go from, stopping the Russian government from getting money, ensuring the Ukrainians are well armed, to full-scale military conflict. And I don't think there's any desire to go there. I think that's why we hit with sanctions hard and quickly, so that we send a message to Putin, look, you're not going to be able to continue this bloody war. There's no point in imposing sanctions after people are dead. The point of imposing sanctions is to stop them from dying in the first place.
What is the objective now? We're going into a new phase of the war where we're basically talking about not the war being fought, but how it's being fought. Do we then need to think about how we end the war? Because at the moment we're in a position where clearly this war is being fought along similar lines to the ones we saw in Chechnya and in Syria. That is unacceptable. Is the war acceptable? Does it make it more acceptable? I'm just wondering how this changes the narrative from the West's point of view in terms of how this war is perceived.
I think what this shows is just how brutal the Russian military is. I always knew they were this brutal. I was expecting things like this to happen. This was why I was so distraught when I saw the war start. But I think these images bring it home to the average viewer. They show just what the Russian military is doing in this country and why it's so important to stop it.
Professor, we'll leave it there. Thank you very much indeed. Tyler Kuster, Assistant Professor of Politics and International Relations at the University of Nottingham. This is Bloomberg.
the war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
So Deutsche Bank's CEO joining the list of German executives warning of severe consequences if Russian energy supplies are cut off. Christian Saving saying, quote, a further deterioration of the situation if there is a stop to imports or deliveries of Russian oil and natural gas. A clear recession in Germany would presumably be inevitable. Joining us now, Andrew Garthwaite, Credit Suisse, Head of Global Equity Strategy. Andrew, do you think a recession in Europe is increasingly becoming the base case? And if so, what does that mean for European stocks?
I don't think it is the base case for really three reasons. First, US growth is still strong. And once COVID is through in China, China is easing policy and recovering. Secondly, we are seeing strong signs of fiscal mitigation in Europe. So Europe's eased fiscal policy by around 1.5% of GDP. And thirdly, we've got to differentiate between short-term hits to oil and gas and longer-term hits. Eventually, oil and gas will be rerouted, particularly oil. The longer-term hit at the moment is more food-related. So while we think European GDP growth could be between 1% and 2% versus the consensus view of 2.5%, I think it's wrong to look for the R word at the moment. What does it mean for European stocks? Well, as we look at them, European stocks, when you look at P relative, sector adjusted or actual, or the performance relative to PMIs, are effectively discounting around 15% downgrade to earnings relative to the US, and as much as a 15 to 20 point fall in PMIs relative to the US. So we think actually a lot of this bad news is in the price, and that's also been reflected, of course, in funds flow.
Andrew, let's go outside of Europe and talk about, well, equities globally, I suppose. Does the pandemic playbook of there is no alternative still apply when it comes to flows coming into the United States, just given perhaps the lack of exposure or relatively less exposure, that perhaps Europe and other parts of the world has to not just Russia, but regulatory scrutiny as well? Does that pandemic playbook of buy tech and therefore buy U.S. stocks still hold right now?
Well, I admit it's largely held for the last 12 years. I think the problem is that ordinarily that holds if, in an environment of growth disappointments, bond yields fall. But what we've seen, particularly this year, and increasingly so over the last 18 months, is periods of equity drawdowns, bond yields rise. And I am concerned here that the 10-year TIPS yield, that's the 10-year index-linked bond yield, which has had a very close relationship with US growth, actually moves up somewhat, because there is, as I'm sure one of your charts is about to show, a near record gap between the 6-monthly change in the 2-year note yield and the 6-monthly change in the TIPS yield. And I think that markets may be underestimating the impact of QT, and remember the Fed owns almost a quarter of TIPS. So a higher TIPS yield is inevitably bad for long duration growth. I think short duration growth, that's okay. So the areas where it's relatively short duration, high free cash flow, which are the more legacy names.
Andrew, do we get a bear market in stocks if we don't get a positive real yield? What is the relationship between negative real yields and bear markets in stocks? Does the real yield need to go positive before that becomes a risk on either side of the Atlantic?
Yeah, well, the relationship between so-called TIPS, real yield, and equities has changed. If you go back to the noughties, higher real yields occurred in anticipation of stronger growth. So actually higher real yields were a good thing for equities. And since really the whole QE issue started, higher real yields have been bad for equities. So certainly on our models, 1% on the 10-year TIPS yield takes around 13% of fair value PE. So I would struggle to be constructive of equities if you thought the 10-year TIPS yield was going to go up significantly, particularly in an environment where profit margins and the profit share of GDP are at an all-time high, which obviously by itself is indicating that there's not much scope for upward margin surprises.
Andrew, talk to us a little bit about the Fed here. In the last tightening cycle, you saw the stock market, at least in the United States, rally in tandem with a hiking cycle. Is that a trend, perhaps, that might repeat itself this time, or are we going down, perhaps, what Jamie Dimon of JP Morgan said in his annual shareholder letter, that this time it's a very non-traditional way in terms of whether or not the Fed can get this right? What is your take on the Fed's role when it comes to what the stock market might do?
I'm afraid tradition depends how long you've been doing this job for.
You tell me.
So since the noughties, roughly since 2000, the stock market has fully priced in the degree of rate tightening on the first day of rate tightening, which is why, of course, we had the Greenspan conundrum.
Right.
But if you go back, and I think the analog is more like February 4th, 1994, then the stock market way underpriced in the degree of rate tightening. And I think that's exactly what we're seeing now. So if you go back to 1994, I mean, history rhymes, of course, in that famous Mark Twain phrase. Yep. But there we saw the market underestimating the degree of rate tightening by 150 basis points, the ultimate degree of rate tightening over the next year. And at one point, it overestimated it during the course of the next year. So actually, although the forward curve ended up only rising by 150 basis points, at one point it actually rose by nearly 300 basis points over what on the pricing of the first rate hike. So I think because the starting point is so extreme, i.e. real rates were so low and inflation expectations were so low, and because to some extent the household sector has delevered and therefore is less rate sensitive, I think the risk is that this analog to this cycle is more like the 1990s, particularly the 94 cycle, than that to which most people have grown up in.
Andrew, a lot of people are getting 10% drawdown letters. What would you say to them about what they should be doing right now?
Selective. I mean, to us, this is not an environment where you can turn around and say, well, there's an easy 10 or 20% on equities. On our fair value models, equity risk premium and fair value P, we're at fair value. Profit margins are an all-time high. When unemployment's below full employment, that starts to be a problem. It looks like earnings revisions are about to turn negative. So you've got to be much more selective. And to that, to us, that means looking at some of the cheaper areas of emerging markets, Brazil, China, for example, and some of the interesting CPI-linked inflation plays which are found in regulated utilities, big cap pharma, industrial gases, and focusing on the word security, energy security, food security, and defense security. So I think selective.
Andrew Gartwaite, Credit Suisse Head of Global Equity Strategy, thank you so much for your time as always. This is Bloomberg.
4 minutes to the European close. This is what the markets look like right now. Generally reasonably well bid. Bit of underperformance coming through from the FTSE 100, but it's really interesting. Stocks are up, bonds are up, energy's up. That's the picture today. We'll dig into the details in just a moment. There are some interesting single stock stories that are worth focusing on. We're going to count you down to the European close. Going to work your way through all of these assets. We should probably talk about the bond market as well. That's coming up. This is Bloomberg. So we're wrapping up the regular session here in Europe this Monday, just counting you down into the close. This is kind of the picture we're looking at. Generally, actually fairly well bid. It's not a great session, but it's an okay session. We've obviously had a lot of volatility recently. We're not getting that today. Look, the FTSE's up by 0.4%, the DAX up by 0.6%, the CAC 40 in Paris is up by 0.9%. Relative to recent history, those are fairly muted moves. Quick look at what happens in terms of the stock session from a sort of chart point of view. 462. We've actually been climbing throughout most of the day. We're hitting near session highs right now. We're up by around 0.9%. So the US kind of momentum is certainly feeding back into Europe right now. In terms of the story surrounding the other assets, it's worth kind of just bearing in mind what is happening here. So the dollar is actually beginning to catch a little bit of a bid right now. We're back sub 110 on euro dollar, so keep that in mind. But what is interesting here is that the German 10-year yield is going lower, i.e. we are seeing bonds catching a bid. Relate that to that. The fear here is that ultimately what we're looking at is a situation where actually European growth is going to be coming down, which is kind of what the bond market is reflecting, and to a certain extent actually what euro dollar is reflecting. And part of that is going to come down to energy, which is why I've got Brent here. as you can see, Brent was just a moment ago trading a little bit higher. We're starting to unwind some of that SPR effect from last week. But the fear here is basically, as a result of what we saw over the weekend coming out of Ukraine, energy gets sanctioned. That ultimately produces a recession in Europe. Certainly a lot of people are talking about that, including the CEO of Deutsche Bank. In terms of the mix, travel and leisure is up today, technology's up, luxury's up, the car sector's up as well. Only a few sectors in negative territory: insurance, energy, basic resources and banks. The commodities are down, which is why you're getting the London underperformance. And you are seeing travel and leisure, technology and luxury doing well. And the car sector not having too bad a day either, up by 1.7%. Talking of which, let's show you what is happening with Volvo. It is trading up by 6.35%. This as Hertz says it's going to be buying a whole load of Polestar electric vehicles, which obviously relates back to Volvo, which is why it is trading higher, which is why the car sector is trading higher as well. Novartis also having a fairly good day today, up by 1.4%. In fact, the pharma sector has had a really solid session today. It's bled out into other areas of the sector. We've seen Novartis trading up. This as it basically announces and confirms plans for a significant cost savings in terms of the organizational structure that it's going to have going forwards. Now, and then we come to Airbus. Airbus down by around 0.5% into the close. The reason for that is that we are seeing a situation where maybe, and this is a fantastic Bloomberg scoop, maybe we're going to see the ramp of the 350, which is a wide-body aircraft, the newest wide-body in the fleet. Maybe the ramp of that from 5 to 6 is going to be delayed. The reason why it's going to be delayed, well, obviously the macro backdrop is looking less rosy right now, despite the fact that recovery in global travel. This is an aircraft that is going to be operated, or theory was going to be operated by Aeroflot. You've also got this ongoing battle, this increasingly acrimonious battle as well with Qatar Airways. Akbar Al Bakr, the CEO there, taking